Capital budgeting. Capital budgeting is the process of evaluating and selecting the long term investment. What are those long term investments? Purchase of equipment, purchase of building, land, etc. So it involves a huge amount of capital investment, nothing but cash outflow, cash outflow or cash outlay. And the firm expects future benefits on this outlay. So future benefits must be quantifiable and we can call it as returns on investment. So those returns are nothing but cash inflows. So in capital budgeting, as we mentioned, it is a process. In this process, we have to evaluate the investment project proposal, how much we invested and how much cost it involves. And we have to estimate the future returns. We have to estimate accurately because future is uncertain, unexpected events may happen. So it is very difficult to estimate the cash inflows. So we have to estimate future cash inflows and we have to evaluate the post-tax incremental cash flows. Only post-tax cash flows we have to consider. And then while selecting the investment proposal, investors always thinks about the maximum returns. Maximum returns. So in this capital budgeting process is nothing but evaluating and selecting the long-term investment. In other words, long-term investment decision making. But in this capital budgeting, some investment decisions are excluded because those investment proposals cannot be directly quantified. Cannot be directly quantified. Say, for example, a firm or a company management decided to construct one recreation room for the employees. So that facility gives indirect benefit to the company because it is nothing but a management and employee relation, and the employees get satisfaction and motivated so that they work efficiently. So it has indirect benefits, but it does not involve direct financial returns. So those kind of decisions capital budget always excludes. And one more thing, the capital budgeting decision are very essential and crucial because it involves huge amount of funds. Once if we invest, we cannot reverse it. It is a irreversible decision. At the same time, if we take a bad decision, it creates huge losses. At the same time, it leads to failure of the business. So that is why these decisions, these long-term decisions or capital budgeting decisions are very crucial. Capital budgeting process. This capital budgeting process depends on the size of the organization and the number of projects to be considered and the direct financial benefit of each project considered by itself and forms existing assets composition, whether the management wants to change the composition and timing of expenditures associated with the projects. Some projects, it's beyond firm's capacity. So in such a case, a wrong step may lead to complete collapse of the business. That is why every business has to self evaluate themselves. What is the size of the organization and how many projects we already considered and to be considered? How much capacity we have, whether we can afford it or not, and direct financial benefits of each projects. At the same time, the timing of expenditure associated with the projects. See, if firm has already doing some projects and the new project expenditure may come at a time. At that time, the cash outflow will be huge. It may be unbearable by the firm. So this is totally depends on these factors. And then planning. This planning, it begins with the identification of potential investment opportunities and then evaluation phase. This phase involves the determination of proposal and its investments, inflows and outflows. So the investment appraisal techniques we use to evaluate the project. So those techniques are nothing but payback period, accounting rate of return, and other modern techniques like a net present value method, profitability index, internal rate of return. So after completion of this evaluation process, selection phase. By considering the returns and risk associated with the individual projects, as well as the cost of the capital to the organization, the organization will choose among projects so as to maximize the shareholders' wealth. So, whatever the project is giving maximum return, those projects firms will select. And if it is an exclusive project, it is comparable with the cost of capital. If the return is more than the cost of capital, then project is accepted. If it is less than the cost of capital, in the sense cost is high and return is low, in such a case, firms always reject the proposals. So, after selecting the project which gives maximum return, the implementation phase begins. In this phase, firms must acquire necessary funds, purchase assets, and begin the implementation of the project. Another one is control phase. The project must be monitored with the aid of feedback reports. So those reports are nothing but capital expenditure progress report, performance reports comparing with the performance against plan sets and post completion audit. And finally, the review process. After completion of the project, firms have to review their project so that it gives new ideas for the new proposals. So, the review process is must whether project is success or failure. In both cases, this review process helps. Why this project failed? Why this project succeeded? How this project succeeded? Can we do more efficiently than this? Likewise, this review process helps us. Nature of capital budgeting decisions. There are many ways to classify the capital budgeting decisions. Generally, capital investment decisions are classified into two ways. First one, it can be classified on the basis of firm's existence, that is, whether newly incorporated or already existed firm. Likewise, another way of classification is on the basis of decision situation. So mutually exclusive project, accept or reject decision, likewise. So let us go with one by one. On the basis of firm's existence, capital budgeting decisions are taken by both the newly incorporated firms as well as the existing firms. If it is a newly incorporated firm, the decisions will be in respect of selection of a plan to be installed. If it is an existing one, the decision relating to meet the requirement of a new environment to compete with the competitors, to face the challenges. So these decisions may be classified as follows. First one, replacement and modernization decisions. Replacement and modernizations aims at to improve operating efficiency and to reduce cost. Generally, all types of plants and machinery require replacement either because of economic life of the plant is over or because of it has become technically outdated. So modernization decision is very essential in some organizations. Say, for example, cell phone industry, mobile. So every day, some new apps are invented. Accordingly, they are changing the mobile technology, cell phone technology. So every day it requires the modernization. In those organizations, these capital budgeting decisions are very crucial. Expansion decisions. Existing successful firms may experience a growth in demand of their products. If such firms experience shortage or delay in delivery of their products due to the inadequate production capacity, at that time they will go with the capacity expansion decision. So it involves huge investments. Then this capital budgeting appears because capital budgeting decisions are nothing but long term investment decisions. Huge amount of investment is required. So another one is diversification decisions. These decisions require evaluation of proposals to diversify into new product lines, new markets. Why? Because to reduce the risk of failure. By the diversification, they can recover the losses from the another market. Likewise, all firms are planning diversification to recover the losses from the another market. It requires a huge investment. So both expansion and diversification decisions are called revenue expansion decisions. So another one is on the basis of a decision situation. So these are classified as first one mutually exclusive decisions. The decisions are said to be mutually exclusive if two or more alternative proposals are such that the acceptance of one proposal will exclude the acceptance of another alternative proposals. If we have two proposals, we can accept only one. In such a case, automatically we have to reject another one. So in those two mutually exclusive projects, whichever project gives high returns and low cash outflow, those projects are accepted. For instance, a firm may be considering proposal to install a semi-automatic or highly automatic machine. If firm installs a semi-automatic machine, it excludes the acceptance of proposal to install the highly automated machine. In the sense, it has to reject the highly automatic machine. Another one is accept or reject decisions. All those proposals which give higher return than certain desired rate of return are accepted and the rest are rejected. Here, the terminology desired rate of return, generally cost of capital, we can call it as. If the return is higher than the cost, then project is accepted. If the return is higher than the desired rate of return, project is accepted. If it is not higher, then rejection will happen. So another one is contingent decisions. The investment in one proposal requires investment in one or more other proposals. So this contingent decision will explain with an example. If a company accepts a proposal to set up a factory in remote area, it may have to invest in infrastructure also. Example, building of roads, houses for employees. Likewise, these are also projects. So the investment in one proposal requires investment in one or more other proposals. This is called contingent decision. Basic principles for measuring the project cash flows. For developing the project cash flows, the following principles must be kept in mind. The first one, block of assets and depreciation. What is the meaning of block of assets? A group of assets falling within a particular class of assets. Say for example, buildings. If a company has a number of buildings, but they will maintain the buildings block, and they will maintain all the buildings value. So that is called block of assets. But here, while calculating the depreciation, we have to be a bit careful about this block of assets. If block of assets contains only one asset, the treatment will be different. And if block of assets contain one or more assets, not one, more assets, two or more assets, the depreciation calculation will be different. Say for example, A Limited acquired a new machinery for 1 lakh rupees, depreciable at 20% written down as per the written down value method. The machine has an expected life of 5 years with salvage value 10,000. Okay, so explanation, treatment of depreciation or short-term capital loss in 5th year in 2 cases shall be as follows. What are those 2 cases? We'll see. So if block has only one asset, the second case is if block of assets has 2 or more assets. So depreciation for initial 4 years shall be common, no change in it. And written down value at the beginning of the 5th year shall be computed as follows. See, purchase price of a machinery 1 lakh, so depreciation rate is 20%. So up to 4 years it is common. So at the end of the 4th year or at the beginning of the 5th year, the value is 40,000. In case 1, there is no other asset in the block. Fifth year, no depreciation shall be charged in this year because only one asset is there and the company is disposing it by claiming the salvage value. See, written down value method at the beginning of the year 5, 40,960, right? So less sale value of mission 10,000. So whatever remains, it is the capital loss, short term capital loss. Okay, so on such loss, tax benefit 30%. Okay, so what if block has more assets, depreciation shall be charged in the fifth year. Let us see. So written down value at the beginning of the fifth year 40,960. Sale value, sorry, sale value is 10,000. 10,000. So this is 30,960 written down value. See here, there is no other asset in the block. That is why we mentioned the capital loss, short-term capital loss. But here still there are some more assets in the block. That is why we had to mention the written down value as 30,960. And then we have to calculate the depreciation at the rate of 20% on that. So 30,960 so depreciation at the rate of 20% on 30,960, that is 6,192. We can claim the depreciation on fifth year also because there are more than one asset in the block. And tax shield, tax benefit on depreciation at the rate of 30%, that is 1,857. Likewise, we have to calculate if the block of assets contain more than one asset. Now, suppose if in the above two cases, sale value is 50,000, then what will happen? See here, the sale value is 10,000. That is why we claimed the short-term capital loss and tax benefit on the loss. And here also, in the second case also, sale value 10,000, written down value method, written down value is 30,960. On that written down value, we claim depreciation and we got the tax benefit. If sale value is 50,000, what will happen? See, in the first case, in the sense, block of assets contain only one asset. The written down value at the beginning of the fifth year, 40,960. Sale value of mission, 50,000. So short-term capital gain arise. So 9,040. If it is a gain, we have to pay the tax. Nothing but that is the tax loss on short-term capital gain. We have to pay the tax at the rate of 30%. That is 2,712. So in case 2, if block of assets contain more than one asset, in case 2, no depreciation shall be provided. Why? Because I will show you here. So in case 2, if we mention 50,000 here, there is no value left because we realized more than the written down value. So it will be 0 or minus. So it will be 0, the value of the written down value, and depreciation also 0. So there is no need to calculate the depreciation. if the sale value is more than the written down value. And another concept is do not include financing costs. Financing costs are nothing but interest payments on debt, interest payment on debt, dividend payments. So these are the financing costs. These financing costs already been embedded in the project cost of capital. So if you claim it again while calculating the cash flows, so it will be doubled. To avoid double counting, finance cost should not be included as part of the project incremental cash outflows. Okay, so the exclusion of finance cost principle means interest on long-term debt is ignored while computing the profits and taxes. Profits and taxes. So we know that profit before depreciation, interest and tax, right? So in that we should not mention the interest because it is already been embedded in the project cost of capital. So profit before depreciation and tax. From that we have to deduct the depreciation and we have to charge the tax. Again, depreciation we have to add it, being it is a non-cash expenditure. So there is nothing we paid. So there is no effect in the cash flows because of depreciation. So depreciation works as a tax shield. Okay, and another concept is post-tax principles. So cash flows must be defined in post-tax terms always in the capital budgeting decision-making process. Okay,